How do you pause?
Um, but what we're going to be doing is Luke Went's going to give us a little bit of information about what his role is here at WDS and talk a little bit about some of the tax planning that we're doing. What we're going to ask everyone to do is if you're not presenting to please turn off your camera, make sure you're muted. We do have quite a few people joining the event today. So just to make sure everything goes smoothly and hopefully it isn't all laggy or anything like that. We'll make sure that hopefully that will help us out quite a bit. And if you have your name on there, can you please have everyone change their name on Zoom to your first and your last name? That way we can check you in correctly and make sure we get everyone listed that is here. Before we get started, before I hand it over to Luke, I just want to make everyone else aware of the remaining events that we have set up for the year. So I will go ahead and share my screen here. Hopefully everyone can see that. But tonight's, like I said, is tax planning. You can find all of these events on our WD Strategies webpage under the events section, client events. Like I said, tonight's tax planning with Luke Went. Our next one in September, 3 weeks from today, I believe, is cybersecurity. Someone from JP Morgan's Wealth Management Cybersecurity Awareness Global Program is going to be doing a presentation on things that people should be kind of keeping an eye on to help protect themselves, their family, businesses, things like that. Our October event is actually a family event. It's a pumpkin carving contest. So as you guys are doing pumpkin carving with kids, grandkids, family members, things like that, if you want to snap a picture and submit that here, we'll have prizes after people vote and everything like that. But it's a good family event for that. The following week in November, we are doing leaf raking for community members in need. So if you know someone that needs help with some leaf raking in the beginning part of November, not just because you want to get your leaves raked, but because you actually need help or they need help. We're looking for families to kind of create an address list. If you're interested in volunteering there as well, you're more than welcome to help out with that. And then our last event for 2022 is in December. It's a good enough workout with a personal trainer, Tyler Smith, just going to be doing a little presentation on some things that people can be doing from their home to kind of get the blood pumping, stay healthy. It's a little intimidating getting back into the gym and everything like that. So these are some things that you can do at home to try to keep yourself healthy and keep going on that side of things. That's our our events here. We will be recording this event and we'll send this out. So if people want to review that, you're more than welcome to. We have some of our past events recordings on our website here as well. So if you go to events, past events, you scroll down under recent posts. So the one that we had in July was sustainable farming benefits. There's that link there to be able to review that there as well. But that's all I had. Like I said, my name is Lucas Marty. I'm one of the advisors here in the office, but I will pass it over to Luke Went for the tax planning information.
All right, thanks, Lucas. We have a lot of Lukes in the office. I am the tax advisor for pretty much anyone who needs that service within in the office. I just want to make sure that you guys are hearing me. If I can get a, all right, perfect. I'm just going to jump right in. My presentation is got a lot of information. We do have a couple people monitoring the chat. So if you have any questions, just go ahead and type it in the chat. If it's going to be kind of a personal question pertaining only to your situation, the monitors are going to pass that along to me and I'll respond in email directly to that. If it's a good general question, Lucas or I think Tom are going to interrupt and just kind of let me know, and I will answer those kind of general questions as we go along. But we do want to try to finish this up by 7. So parts I will go very quickly because they're not that important. If I'm slowing down, it's because that's kind of the important stuff that is going to make a big difference. So just kind of keep that in mind. Definitely not everything is going to pertain to everyone on this Zoom, but it's just to give you some ideas going forward. So let me share my screen. And then of course, goes in and blocks all my controls. Uh, so as a enrolled agent,
Sorry, I'm having trouble understanding right now. Please try a little later.
basically I am entitled or licensed to represent any of you with the IRS for any tax areas. What is a tax advisor in general? We're not anyone who works for the government. We're not your enemy. We're not detectives. Why I mean that is if you know some information, don't expect your tax preparer to find that or discover that. If you know, just jot down a note. Let us know of a specific situation, maybe something that happened last year that carries forward, something like that. If you're using the same preparer year after year, it's not as important because that information is saved. But if you're a new client to that tax preparer, that's always something good. We work for you. Our goal is to legally reduce your tax liability. And we do, a true tax advisor will help you plan. But the time to plan is not when you're filing your taxes, it's when you're going forward throughout the rest of the year and how to preemptively make sure that your tax plan works out. If I am your tax preparer, just a couple quick housekeeping things. When you're providing your documents, we scan everything in. It's an electronic file. So if you have staples, paper clips, Post-it notes, that takes a very long time to remove all those items. And then if you have anything that's like a half sheet or anything like that. Now, some of the tax documents I understand come in not full-size pages, but anything that you're adding in, if you use a full sheet of paper for that, it's very helpful when it comes time for us to enter that data into our archiving system. So what's changed for 2022? Most of these items are just kind of general increases because the year changed. So the first one is a major change, but if you don't have children that are under age 18, probably not going to notice this, but the child advance tax credit is eliminated for the year and going forward. And then there's also reduction of the child tax credit and dependent credits. The earned income credit, which is for lower income families or individuals, you now have to be between age 25 and 65 to be eligible for that. That's kind of how it always was, but it was suspended during the COVID pandemic when we were in the midst of that. So those age restrictions are back. The next one is something that actually is different, and it can pertain to you if you are selling things specifically online, but not necessarily online. But basically, if you use a third-party vendor. One example that I personally experienced is my family are Packers season ticket holders, and driving up to Lambeau is a long drive. So we end up selling quite a few games. They're sold through Ticketmaster, which is a third-party vendor, and they handle all the credit card transactions. And because of that, last year, for the first time, we had to report our social security number and we're going to get a 1099K because we've sold more than $600 worth of Packer tickets. If you're selling something on like Facebook Marketplace or Etsy, something like that, and you're using like a PayPal or any type of vendor like that, and they ask for your social security number, the email is going to look like it's a scam. It reads very, very bad, but it is actually a legitimate reason because those pay vendors are required to fill out this 1099K. If you're selling something to a family member or using like a Venmo just between friends, you're not going to have that reported. It's only for items that are going to be considered a sale of some sort of goods or service. The above the line charity deduction is eliminated currently. Last year there was some confusion on this. If you're married, you could claim standard deduction plus $600 of charitable donations, or single standard deduction plus $300. And that was not available until around January is when they announced that, yes, it's going to be available. So this year it's gone for now, unless they add it back in. Required minimum distribution rates are reduced to match life expectancy, and those tables are from 2019. If they update that again next year based on 2020 or 2021 life tables, life expectancy has actually gone down for the first time in this country in a very long time because of the pandemic. So that's just kind of where it is. Double E and I savings bonds, your income limit increases if you use those for education. Kind of a niche product. They haven't been available since around 2005. So if you have any of those floating around and you have an immediate family member, or you're personally going to use them for education, there might be some tax savings there. Social Security income ceiling, if you're still working, after you make $147,000, you don't have to pay Social Security tax anymore. Medicare surcharge starts at $200,000 of earned income. Business mileage, if you're self-employed or fill out a Schedule C of any sort, it's going to be 58.5 cents a mile. Your health savings account contributions have increased by $50 this year, and that would be $100 for family. Self-employment, the 20% deduction increases to an income threshold of $340,000 this year. So if you have self-employed income, a lot of you have investments through wealth distribution strategies and different types of real estate, like real estate investment trusts or other versions of that. Sometimes there are deductions that come along with that through this 20% deduction. So that's just part of the Tax Cuts and Jobs Act. Real estate personal exemption is $12.6 million per person. So this is commonly known as the death tax. So if you pass away with an estate worth more than $12.6 million, that's when your heirs will start paying taxes on that inheritance. The one thing I want to let everybody on this know is that you don't have to die to use this exemption. You can give away your property, some money, whatever you want, while you're alive. And the next line down, if it's below $16,000 per person that you're giving that gift to, there's no reporting required. If it's more than $16,000, now you have to fill out an exemption, and you're dipping into your $12.6 million personal lifetime exemption. So just a quick example of this, if you have a child that you want to help buy a house and you're going to give them $100,000 for their down payment, that's fantastic. If you don't fill out a personal exemption request, you have to pay the gift tax. You, as the person that gave the money, would pay 45% tax on that $100,000. Or you fill out a form, or better yet, have your tax professional fill out that form that says, no, this was a gift. I'm going to go against my lifetime personal exemption. Now, when you pass away, only the first $12.5 million of your estate passes tax-free. All right. Some items that are set to expire. Now, I created this presentation about 3 months ago, and that's how quickly the laws can change. So there's 4 items that were expired that are now back on. But the first 2 on this list, mortgage insurance premium deduction. So this is if you have a mortgage that is more than 80% of the value of the home. Typically, there's an insurance premium, and in the past that was able to be deducted, and that is no longer. And if you're part of certain medical unions, part of your insurance premiums over and above can be deducted previously, and that has gone away as well. The recent law that just passed last week brought all of these other items back into play, and I'm going to go into that in a little bit more detail. So this is all brand new information as of literally last week, I believe. The Inflation Reduction Act is talked about quite a bit in the news, and it's a big bill, and I read most of it yesterday. I read the entire summary, and then I dug in. 235 pages. I didn't read all of it, but I read the parts that I was confused on. I'm not going to go over all of it, but I'm going to highlight a few things. So first thing that they're talking about in the news is it raises taxes. Well, it does on certain corporations specifically. There is a 15% alternative minimum tax rate for corporations after they make their first $1 billion. So you can make your first $1 billion. It can be tax-free as a corporation. Once you get above that, then 15% tax is going to be required. There are some exemptions on that. So if you are a S Corp personally and you're making over $1 billion, you're exempt. You don't have this 15% tax. Where it actually affects probably people on this Zoom, regulated investment companies and real estate investment trusts, they have over $1 billion. Now, you might be a shareholder in those. And by might be, I mean you probably are if you're on this call. Those are also exempt. So there's not going to be an additional tax drag on those investment vehicles. So that's good for everyone on this call. Another part that is affecting corporations is stock buybacks. There's going to be a 1% tax on any repurchase or buyback of company stocks, and that's going to start January 1st next year. Where I see that this might actually have some impact on the investment world is there's kind of been a false bottom within the market with buyback orders from large companies like Apple, Amazon. They have a lot of cash on hand. And if their stock price drops a certain amount, 15, 20%, there's a trigger set up where the company will automatically start buying their own stock back. And that kind of gives it a bottom when the stock price starts to fall. And as a result of that, we haven't seen real plummets from kind of the larger indexes, the larger cap stocks. This 1% tax might discourage those buyback programs a little bit, and we might see a little bit more volatility because of that. But that's just kind of educated speculation, I guess, on that front. The other thing that's being talked about a lot is increased funding of the IRS. There's enough funding to hire 87,000 new IRS agents. There's currently 75,000, and I could not be more happy about this because if I have a problem with a tax return right now, it's about a 4-hour wait to talk to someone on the phone before hold time. So if I can actually call in and talk to somebody in a half an hour or 20 minutes, that's fantastic news for me. Bloomberg is estimating that audits will not actually increase until 2026 or more likely 2027. And the news is also saying, the IRS is coming for you. Well, if you've been cheating on your taxes or not paying your taxes, yes. But if you've been doing the right thing, like most of us have all these years, this is actually a good thing, because if you have an honest mistake, which definitely does happen, we can get those cleared up much quicker. So that's actually a pretty good thing as well. There's some prescription drug reform, most specifically for Medicare. There's going to be required negotiation for pricing, and that's going to hopefully lower the cost of Medicare in the future. There's also going to be some required rebates for drugs that are newer that don't have a generic equivalent, so that Medicare can basically pay less for that. They are also lowering the out-of-pocket costs for the users of Medicare. Your max out-of-pocket going forward is going to be $2,000, and that goes into effect in 2025. So that's also good news if you're on Medicare, especially if you have health challenges. Extension on the Affordable Care Act expanded subsidies. If you are under the age of 65 and you want to retire early, this is great news for you. This will allow you to have access to subsidized premiums through the healthcare exchange, even if your income is relatively high. You can be over $100,000 of earned income and still get a pretty nice subsidy. And if you're in that situation, we also have Shane Roth in our office that is an expert on that area. Shane and I worked with together to kind of figure out, okay, how much is this person's income going to be in retirement, and then where does that put them for subsidy? And then we work with the in-house advisor, whether it's Lucas or Kyle or Jeff or Jeremy, Tom, and we figure out how much income should we be at, and where does that fit, and where does it make the most sense. And that's all right in-house here at Wealth Distribution Strategies. And the last thing I want to highlight is that there are some increased subsidies for clean energy products. So if you're thinking about switching your house to wind or solar, that subsidy is now going to be as high as 30% of the entire project. And then if you're also going to be replacing some major items like furnace, windows, that type of thing, there's going to be some increased subsidies there as well. So that's all brand new, part of the Inflation Reduction Act that just passed. There's a lot more to it, but we're not going to focus on that. This is just a quick chart on what the new tax brackets are going to look like for 2022. Not really much to say about that. Just kind of find your income, where you're going to expect to be. But we're just going to kind of skip through that for time. Should you itemize or standard deduction? Well, with the Tax Cuts and Jobs Act that went into effect in 2018, standard deduction went up significantly. So if you're single and under 65, you're at $12,950, over 65, $14,700. Head of household, and then married filing jointly. The top one is if you're both under 65, middle is one is over 65, one is under, and the 28.7 is if you're both over 65. So those are your standard deductions. Now, if we are going to itemize, we want to make sure that we overcome that number. And what we can use to itemize has also been greatly reduced by the Tax Cuts and Jobs Act. First thing is medical expenses. You have to consider how much money you actually make before you can figure out how much your medical expenses will be reduced. So 7.5% of your AGI there's no actual credit on that. So let's put some quick numbers to that. If your adjusted gross income, AGI, is $100,000 and your medical expenses are 7,500, you get to deduct a grand total of 0 of those expenses because that's only 7.5% of your AGI. If you have 8,000, now $500 of that counts towards itemizing. The other thing that has been reduced is your state and local tax. So that's SALT. That's what that acronym stands for, state and local tax. So your property tax, your state sales tax, all of those, if you have a county tax or city tax, something like that, that's capped at 10,000. Now, if you have, I would say, a moderately nice house or nicer in Dane County, you're probably pretty close to maxing out on your property taxes. So Wisconsin is a relatively high tax state for state and local taxes. So we're affected by that cap more than other states are. The other thing that you can deduct is your mortgage interest if you have a mortgage, and then charitable gifts up to 60% of your AGI would be for cash donations. And then there's limitations on if you like give items of goodwill, that type of thing. So there's other kind of formulas to figure out what your charitable donations are. But we would total all of those up and see if you overcome that standard deduction before we decide if we're going to itemize or just take standard deduction. The loss from a federally declared disaster, you would definitely know about that because it would be something like the Mississippi flooding that we experienced almost 2 decades ago, or like one of the large tornadoes that would wipe out the city. Those are federally declared disasters, and losses suffered there would also be deductible, itemized, but that's kind of where the limitation is. Big highlight, state deductions may differ. So the state of Wisconsin, your charitable gift donations, we do want you to keep track of that because you might, if you don't itemize for the feds, you might actually get some credit for the state on that. Same with medical expenses, mostly medical premiums are always deductible from the state of Wisconsin. We have to enter those in manually for you. So, Social Security is always a important topic to talk about, and it can be a little it can be political, and I don't want to go that route. I just want to kind of give you some idea of where we are and what some of the proposed solutions are. So right now, Social Security is fully funded up until 2034, but that's not quite accurate. There's 2 parts of Social Security, and if they take from one to pay the other, it's fully funded for both sides until 2034, but each side is funded for different time period. So the OASI, which is Old Age Social Insurance, and that's what we typically think of Social Security. Once you turn 62 or 66 and 8 months, or wait till you're 70, and you start collecting that Social Security payment for the rest of your life, that's what OASI is. That's fully funded until 2033. And then DI, or disability insurance, is fully funded until 2057. Now, when we say fully funded, what does that mean? Well, if nothing is done by 2034, both sides would reduce their payment benefit by 22%, and then continue to reduce their payment up to 26% by 2095. And it will continue to pay benefits, but at that reduced rate. So that's if we do nothing. Now, the Congressional Research Service, which is an auditing division of Congress, said that all we have to do is increase the payroll tax from 12.4% to 15.8% by 2034, and then gradually increase it up to 16.7 by 2095, and we'll avoid that shortfall and all benefits will be paid in full. Now that does require an act of Congress to actually raise taxes. And Congress always kind of has their own solutions for these problems. And this is just kind of the math behind it. Now, when we look at these numbers, keep in mind that if you are employed, the employer pays 1/2 and you pay the other half. So currently it's 6.2% that the employee pays, 6.2% that the employer pays. If you're self-employed, you get the privilege of paying both sides. Now, I do have two proposals, one from each side of the aisle. This is what I could find published. This is not anything, I'm not trying to sway you in one way or another. I'm just going to read them and then we're going to move on and not discuss it beyond that. So the Democrats' plan, this is from the Social Security Act, which was a House resolution bill. So this is what I could find that was actually written down. Their proposal is to increase payroll tax from 12.4% to 14.8% over the next 20 years. And then to increase the payroll ceiling from 147,000 to 400,000. So currently, once you reach that income level of 147,000, any dollar you earn over that, you do not pay into Social Security. So they wanted to raise that that ceiling level. They also were proposing changing the recipients of Social Security, so people on the receiving end, for individuals to have their first $35,000 be tax-free, or for couples to be their first $50,000 to be tax-free. Currently, those levels are at $25,000 and $32,000. Now, this was a voted on bill that passed the House and was blocked in the Senate, but no one did actually the math on it to see if it was going to work. So the results are considered unquantified. Republicans' plan, this came from the published American Rescue Plan. This is step 5 for economic growth. They are wanting to tax Social Security recipients at all income levels, eliminate the payroll tax altogether in 2034, stop payments in 2034, except for disability insurance. And then they want to switch over the Social Security program to private investments. Not only are the numbers unquantified, but there's a potential breach of contract law because Social Security is a social contract, and it is an insurance contract. So whether this will happen or not, I don't know. All right, moving on to a little lighter topic. My great Aunt Erna is the lady pictured here. This is about as happy as she's ever looked. She was very crabby, but I loved her. She taught me how to play cards, shake dice, shoot pool. I have fond memories of my great Aunt Erna. Not everybody has one, but we all have to worry about Irma. We all have our Aunt Irma we have to worry about. And that is an acronym for the Medicare Income Related Monthly Adjustment Amount. So what in the heck is this? If you're over the age of 65 and you're on Medicare, which more than likely you are, if your income as an individual or as a married couple exceeds these brackets, you have to pay additional Part B and Part D cost of premium. And this is something that is required in retirement. This is your only required, basically, expense that you have. Now, when I say it's required, do you have to sign up for Medicare? You don't have to, but you kind of have to. Because if you don't, the penalty is just all of your Social Security. So if you started Social Security at age 62 and you turn 65 and you don't sign up for Medicare, and you're like, I don't need it, I don't want to pay that premium, then the Social Security Administration is going to require that you pay all of that Social Security back until you sign up for Medicare. And then there's a hefty penalty going forward for the rest of your life as to how much you receive. So you kind of have to sign up for Medicare. And you're agreeing that if your income goes above these levels, that you're going to pay more. Now, when this was actually implemented, it was targeted to only affect the extreme wealthy in the country. And I don't know who did the math, but it didn't work out that way. So over 9 years, if you do not pay any adjustments, your out of pocket, out of actually your Medicare check, grand total is going to be 41,000 and some change for Part B. Part D is going to be 8,200 and some change. If you're in the highest adjustment bracket, it's over $100,000 more just for Part B, and almost $20,000 more for Part D. And that's just over the course of 9 years. And why do I go out 9 years? Because that's how far out the Medicare trustee report will report what their expected inflation numbers are going to be. So those costs are going to inflate, and that's already built into these numbers. Now, this report is from 2021, prior to kind of our heightened inflation amount. Now, these numbers are published. They can change, but over the short term, probably the next 2 years, they're pretty good numbers. Beyond that, we might actually see some adjustments. So if inflation sticks around for longer, those numbers definitely could go up. So we're going to dig into this a little bit further. I'm sure a lot of you have heard that, well, my Social Security is held harmless. You've heard that. And it is if you stay under a certain income level. But once you exceed and get into that Medicare adjustment bracket, now all of a sudden your Social Security actually, the payment you receive can be reduced. So if your Medicare premium goes up and you're under that first threshold, what you take home will stay exactly the same. However, this chart shows kind of the scenario of the high income earner. Well, if you see the numbers here, $75,000 is what this person earned on average while working. When they were 60, they're saving 15% into their 401k, and they retired at age 65. All of their money that they saved is tax deferred, so they're going to end up paying more premiums. And you can actually see your take home by the time you reach your 90s is going to be about half of your Social Security, because half of it is going to be paid to premiums for Medicare. And that's just this particular scenario. If you're in the, oh, that's just a higher resolution. This would be if you're in the top income bracket, your Medicare premium can actually be more than your take-home Social Security. And if you live to about age 96, 97, your premium can actually exceed your Social Security. So you will have to pay in for just your Part D and Part B premiums, receive no Social Security, but then pay taxes on all of that income because you still receive that income. It just went directly to Medicare. So when you meet with advisors at WDS, we're very conscious of this, and we're always looking at how is this going to affect your Medicare premium in 2 years if we do this Roth conversion, if we take this big lump sum. So we're going to have those conversations with you and make sure that this does not become your situation where, you know, there's definitely the chance that we might blow up your Medicare premium bracket for 1 year. And that means that 1 year you're going to have higher premiums. But we don't want to do that on a consistent basis. Everyone's situation is unique, and we always kind of tailor it towards where you're at. So before we looked at a shorter time frame, a 9-year time frame. This is over a 25-year retirement for a couple in Wisconsin with no adjustment. So you're fully loaded up. You've got A, B, D, and a supplement. So your premiums over 25 years are going to be $480,000. Now, again, that's spread out over 25 years, and it comes out of your Social Security, so it's a big number, but it's just what it is. Where we can actually make a difference is keeping you out of those adjustment brackets. And the highest adjustment bracket, as right now, over the same 25 years, cost you over $500,000 more for the exact same coverage. You're not getting any more benefit. You're just paying more for that. So we definitely want to make sure that that is not the situation. If you end up paying a higher Medicare premium and it's because of certain events, like maybe you retired and there was a big bonus that got paid out because you retired. There are certain events that we can get that adjustment waived. And we have to file an appeal with the CMS, or the Centers for Medicare and Medicaid Service. There's a pretty simple form that fills that out, and I can definitely help you with that. If you find yourself in that situation and you're like, well, my income went up this year, but it was a one-time thing, and let's see if it qualifies. So we can definitely have that discussion as well. Okay, last long topic, Roth conversions. We talk a lot about Roth conversions at WDS, and there's definitely a method to our madness. When do they make sense? When don't they make sense? Well, let's dig into that a little bit. Historically, taxes are low right now. They've been as high as in the 90s. Average was kind of in the 70s. Now this goes back to 1913, because prior to that there was no income tax in the United States. So that's when we started income tax, and these every 5 years is where these are plotted. Now the bottom number is the lowest bracket. So historically, we're closer to the low side than the high side. So if we just take a quick look at some case studies, Roth conversion would make sense in this situation. Now, this is not any particular client. These numbers are completely made up. But if we have a client who's mostly retired, but they have a little bit of earned income, $5,000, their pension and IRAs pay them $57,000. They have $24,000 in Social Security. They receive $40,000 in dividends, $15,000 capital gains. They're married and taking the standard deduction. So if I'm meeting with you and we're figuring out your situation. This is what the software is going to look like. And this is going to be a living graph where it'll show kind of where everything is. This is just a screenshot, so it's not quite as interactive. But basically, every $1,000 of income that we add, and in this case, we're talking Roth conversions, this would be the tax rate that you'd be at. So every $1,000 that we add would be in the 22% tax bracket for this up to 50,000. Now this dotted line is the first Medicare adjustment bracket. So we would maybe consider not converting beyond that. Over here, we're going to have a tax increase going up to the 24% bracket and another Medicare bracket. This little brown bump here comes from net investment income tax. So we are able to take into account all the different areas where taxes are compounded or certain deductions might be phased out. All those types of things are going to be taken into account. Capital gains show up over here. So this is a nice picture that explains where you want to kind of stop for your Roth conversions, and we have those conversations with you. Does it always make sense to do a Roth conversion? No. This is a client that it really doesn't make any sense. So this client has taxable income, earned wages of $1,500, pension IRA just $15,000, Social Security is the same, $24,000. They only have $4,000 in dividends, $1,000 in capital gains. They're also married, taking standard deduction. They're currently paying 0 tax rate. Every dollar that we add phases out earned income credits, phases out or phases in Social Security income. So you go from 0 to 24 or 22% very, very quickly in the matter of about $10,000. Now, once all of your Social Security is taxed, then you go back down to the 12%, and then there's a big spike for your capital gains going from 0 to 15. So again, you can see this is a very complicated picture, that there's a lot of moving parts here that without kind of knowing all of your income, knowing where everything is, where it's all coming from, it can be very easy to make a mistake and cost you higher taxes. So in this particular case though, you're right up to that line where you're at 0 taxes, so it doesn't make sense to pay taxes to convert, to avoid taxes. Well, no, that doesn't make sense in my book. The other discussion that I like to have multiple times, because it's kind of a complicated issue, and when you hear it, it makes sense, but then when you're actually going through long conversion years, it gets difficult to stomach, because when you are in the middle of converting money from traditional IRA to Roth IRA, you're taking a bunch of your money and moving it from this pile over here. You're not actually seeing it, you're not spending any of it, and you get to pay a lot of taxes. And it's very, very frustrating as a client. And let's just go through the method to the madness one more time. And these are all, again, hypothetical numbers, round numbers. So we're going to start with $100,000 in your account, and we're going to have a market drop of around 20%. So now we have $80,000, and we're going to convert all of it. And that's going to put you in the 24% tax bracket. So you pay 24% tax on 80,000. So you pay $19,200 in taxes. That is not fun. And you don't get to spend any of the money. 5 years later, well, the market recovers 25%, 25%, then it's flat, and then 28%. And now you have $160,000, and you can access all of that money and not pay any taxes. So the grand total of taxes that you paid is $19,200. That's when it becomes a lot easier. By the way, these numbers average out a return of 11%. So these are not unrealistic numbers. It's kind of what the market does. It gives big gains and then it gives you losses. It's never a nice, smooth, oh, 8, 9, 10. It's always a little more of a roller coaster. So that's why I kind of use those bigger numbers. In the same scenario, if you decide, nope, conversion's not for me, well, you end up with the same dollar amount, 160,000. But the Tax Cuts and Jobs Act have expired, so your tax rates have gone up. Half of it is taxed at 25%, half of it's taxed at 24 or 28%. So you pay a grand total of 42,400 to access that same 160 that you would have 160,000 and you would have paid 19,200 in taxes. So much smaller number with the Roth conversion. The other strategy that I hear people say is, well, I'm just going to take withdrawals over time up to the tax bracket to get it out of my IRA and put it into a non-taxable account. So then, kind of the same thing. Well, that doesn't work as well as just doing a straight up Roth conversion either, because if we do the same scenario, so the market returns are -20, up 25 flat, and then up 28, and we're going to try to take 20% of the account out every year over 5 years to get it all out before the Tax Cuts and Jobs Act expires. Okay. So we're going to mostly be in the 22% bracket while we're taking that money out. So $80,000 over 4 years. So we take out 20,000 and we lost 20,000 because of the market. Next year we gain 25%, but we took out 20,000, take out 20,000, take out 20,000. So we have $80,000 that we've taken out. And this is more fun because you've spent it or saved it, but you have access to it, right? Well, you've paid $17,600 in taxes. Well, that's less than what you paid for the Roth conversion, right? But now the Tax Cuts and Jobs Act expires, and that 22% bracket is now 25. So that last 20,000 that you've taken out, you pay 5,000 in taxes. So you paid a grand total of 22,600, which is more than the 19,000 that we paid originally. And we still have 42,400 in a taxable account that we'd have to pay taxes on to access that as well. So the taxing isn't done in this scenario. So Roth conversion is complicated, it's painful, but in the long haul, it makes the most sense. Also, when you take money out of your Roth, that's not taxable according to your Medicare premiums. So you could have higher income and not have Medicare premium adjustments. So that's another big reason why we like Roth conversions. Quickly touch on inflation. We're getting late, so I'm not going to spend a lot of time here, but it's been in the news. What is inflation? Basically, it's just the dollar buying power is decreased over time. So a dollar can buy more today than it can buy next year because of inflation. What causes inflation? Well, that's extremely complicated. And if anybody tells you it's one thing, they're lying to you. It's a series of events, and why we're experiencing it now has a lot to do with the money supply, the amount of cash that was injected into the economy because of the pandemic, the reduced supply of goods. Things got shut down, supply chains are screwed up. So the access to what people want to buy with the money that they have causes the price to go up. And just the overall, demand hasn't gone down. So that's roughly the same, maybe increased a little bit. Um, but there's a few things that have happened that really exaggerated kind of the problem. And you've probably heard a lot of it on the news. And the one thing that you don't hear on the news that I just want to call your attention to happened in March of 2020. And the Fed actually lifted the bank requirement to have a 10% reserve on deposits. So basically what that means is that if you deposit $1 at the bank, they don't keep the money. They lend it out and charge interest on that. Well, previously they were only allowed to lend out 90 cents of that dollar. And that went away. So how it used to work is basically if you inject $1 into the economy, it goes into the bank, they lend out 90 cents, it comes back in, then they lend out 81 cents on that 90 cents, and so on and so on. Basically, it nets down to around $10 is circulated off of $1 being injected into the economy. Well, when they lifted that 10% reserve requirement, now the bank can lend out the full dollar, and then that gets spent and put into another bank, and they can lend out a full dollar, and it becomes an infinite loop. So the supply of dollars into the economy is out of control, and it's not necessarily even being regulated by the government or the Fed, who's supposed to be. It's the supply is actually, banks are almost allowed to print their own money at this point. So that's one area that I'm definitely concerned with. Hopefully that gets put back in place where that doesn't happen anymore. But as of right now, that's what's going on. So the Fed is slowing how much money they're putting into the economy. But because of that rule, the banks are actually still, so the money supply is still extremely high. And there's two places that you can really see the result of that. First is something called the velocity of money. How many times a dollar changes hands over the course of a year. And back in the late 90s, when the economy was like really, there were jobs everywhere, and there was no inflation, there was no pandemic, it was, things were good overall before the dot-com bubble. But at that point, the velocity of money basically was 8. So a dollar would change hands 8 times throughout the course of a year. So it would turn over that many times. Well, right now it's at 1.1, which means that almost every dollar that's being spent is a brand new dollar. That's how much money is being injected into the economy right now. And, more supply of dollars means that people have more money to spend, which means that increases demand, which means, all those other reasons why we have inflation. So definitely not one reason, but that's just one that I don't hear enough people talking about as part of the problem. So how do we protect against inflation? Historically, investing in equities is the right answer. This year, that hasn't been the right answer. But we at Wealth Distribution Strategies have proposed some kind of alternative products, alternative investments that will hopefully hedge against inflation. Bonds and cash are not necessarily the best place to be in an inflationary environment. Cash for sure, you're just guaranteeing that you're losing money. But sometimes, that's better than losing 20% in the market. So do we have an exact answer on that? I wish I did. I really, really wish I did. All right. Just very quickly, in the US, there are 2 tax systems. People have probably heard that before. What does that actually mean? Well, there's taxes for individuals, there's taxes for businesses. They're very, very different in the way that they're treated. Their tax brackets are now different. But as an individual with a business, Now, this can be something that is a hobby. Now, I'm not gonna say that, oh, we can pretend like you have a business. No, if you have a legitimate interest in something in your retirement that you want to pursue a business, there are some tax savings involved with that. Good example would be, like writing books, or I have a couple of people that are authors. If you want to get into like arts, woodworking, that type of thing, something that you can make a legitimate attempt at being profitable. This is the list of things that you get to deduct as business expenses. And a lot of them are things that you would already, be doing just in your everyday life that now can become tax advantages. For most home businesses, utilities, like your internet connection, cell phone, those are things that you have to have to run a business. Mileage is always a big write-off if you have a business, those types of things. So again, if you come to me and say, well, I kind of think I might want to write this stuff off, but I don't really do anything. Well, no, that's fraud. We're not going to do that. But if you have an interest in something that, yeah, I want to make a go at this and make some extra money in my retirement to stay busy. How can we work that into our tax savings? And, I'd love to help you in that aspect. Last item, really briefly, if you are a married couple in Wisconsin and one of you needs more help than what can be provided at home, and you have to go into a skilled nursing facility, there are ways to protect your marital property from basically day one, even if you don't have a trust in place. It's a very, very tedious and complicated process. So the best time to plan for this is like yesterday. And if you didn't do it yesterday, well, tomorrow is just the next best, because today, everybody's closed. But if you keep kicking the can down the road and one of you has to go into a skilled nursing facility, there are ways that we can structure your holdings. It's very expensive at that point because estate planning attorneys need to be involved. But basically, the day that someone has to go in, give your advisor a call, and we'll see what we can do to help. There is a look back period. If you're an individual, you're not married, and the look back period applies, and that's 5 years. And there are some special circumstances. This is a very, very complicated scenario that can happen. But I just want to let you know that, that's something that, we have relationships with estate planning attorneys, and, our advisors are pretty well versed in that. I've personally, had quite a bit of experience with this as well. So not a fun topic by any stretch of the imagination, but that is the last topic I want to touch on. Is there any questions that we wanted to answer for the group from our moderators there?
Hey, Luke, this is Tom. I don't know if you can see the chat there, but one of the questions that just came up, I'll read it to you. In one of your first slides, you indicated that the role of the tax advisor is to work with the client throughout the year for tax planning purposes. Are there any plans to meet this year with those persons?
Yeah, I've been meeting with clients throughout the summer. And, as you get your semi-annual meeting or annual meeting or whatever with your advisor, you can always ask to meet with me. The advisors, a lot of them have been kind of getting just the tax plan report that they'll go over with the clients. So yes, that is definitely something that we're offering. I am available. So if we haven't gotten to you or contacted you and you'd like to meet with me, you can always reach out and get you on my schedule. It's not totally full at this point, so we definitely have some room. Absolutely, yes.
Hey, Luke, I typed a question into the chat, and I'm not sure I understood the skilled nursing thing. Are you saying that we should be taking some action now, or we should wait until skilled nursing is needed?
So it's always best if you plan ahead, because you have a lot more options that way. Basically, the best tool for skilled nursing planning is a trust. There are different versions of that. There can be something called an irrevocable trust, and that's what is going to protect that asset from a nursing home kind of going after your house or that type of thing. But you do give up control of that asset. So you have to have a certain situation in place. The best is when you have one or two children that you completely trust to do what's in your best interest. And you have that trust put in place where you still own the trust. The trust owns the property, your house, your whatever, and but you just don't get to make any decisions on it. Your children then make the decision. So, if everything is good and they are going to take care of you and do what's in your best interest, that's the perfect circumstance. That's kind of where I personally am with my mother-in-law. We did that about 5 years ago. She's now suffering from dementia. So, it's going to save the vast majority of her estate if she ever has to go into a skilled nursing facility. We take care of her at home now, but we probably won't be able to do that forever. So. All right. There are definitely some other questions. I think we're getting, we're a little past 7. What we'll do is get back to everybody specifically on those questions. And I do appreciate everybody taking some time out of their evening. And yeah, thank you so much. And definitely reach out if you want to meet with me one-on-one anytime throughout the year. So, all right, everybody have a great night.